Now this is the final video on this LBO part. What we have covered so far, we prepared a quarterly income statement model for Kellogg's company, and then we prepared annual income statement, right? Based on the quarterly projection, we prepared the annual. In the annual, we just did the total of the quarters, right? First quarter, second quarter, third quarter, fourth quarter. The total of that will be the annual data, annual income statement, right? Then we forecasted the balance sheet, we prepared cash flow statement, debt schedule, cash flow statement, and these are the schedules for that. After the preparation of our complete three statement model, we proceeded to LBO analysis. In LBO analysis, I told you what we do. We acquire the company by taking a huge amount of debt. In our case, we are taking 70% debt and 30% equity. So whatever amount we have to pay to acquire the Kellogg's company, we are investing only 30% common equity, and remaining 70% we are taking external financing like debt. Okay, now, so what we have covered so far, we have calculated the sources of funds, and we also calculated the uses of funds. And after that, what we have done, we have prepared the income statement after acquiring it, right? If we acquire this company, what will happen to this company's income statement after the acquisition based on LBO? Then what we did, based on the cash flows which we will be generating, we started to pay our debt, because that is the concept in case of LBO. Today the equity is 30%, 70% is debt. After 5 years, 4 years, debt will become, let's say, 30%, and equity will become 70%, because whatever cash the company will generate, we will use that cash to pay our debt. That is the concept. So we are acquiring the company today after taking 70% debt. We will use that cash that company will generate, we will use that cash to pay the debt, and cash that will be paid significantly over next 4-5 years. After 4-5 years, we will sell the company, and remaining debt will also be paid from those cash flows. Now the cash which will be left for the equity owners after 5 years, we will calculate the IRR. That is the main concept here. Okay, so what we are doing here, we calculated the cash flows. Using these cash flows, we started to pay our debt. Like in this case, this was the total debt initially, and after 5 years, look at the situation. The debt is only 8529, which was earlier 19,000, right? So what we have done, we have started paying our debt using the cash which we have generated in the next 5 years. I think I'm making my point clear. Let me delete this. Now we are coming here, and here what we want to do, we want to calculate the IRR, and the IRR will be calculated based on the cash flows left to the equity owners. Okay, to calculate that cash, we need to calculate how much money, how much cash we are going to receive if we sell the company. So let's first assume the exit multiple, which we have already written here in this LBO model. We had assumed that the entry multiple and exit multiple will remain same. However, you have the option not to keep it same. We are right now creating the model. Based on the model, we are calculating something. Now you change the assumption and look at the effect of it on the final outcome. Okay, as an analyst, our main job is to design the model, then discuss with the client what assumptions are suitable to him, and based on the assumption you can set your entire model, right? So this was the exit multiple. Now we need the EBITDA of 2023. Okay, let me do all of this in 2027. Let me bring my multiple here. What I am assuming here, I am assuming that I will be selling my company after 5 years. Okay, we bought this company in 2000 22 and we will be selling it in 2027, right? Now exit multiple will be this. What will be the EBITDA? You have calculated above. Just come here and find out your EBITDA. Yes, this is my EBITDA. Now if you multiply these two values, you will get your enterprise value, the value at which you will sell your company. And this is what you are assuming today in 2022. Okay, you are assuming in 2022 that after 5 years, if you sell the company, this is the amount which you will be getting. Now we need cash. How much cash we have here? This is my ending cash, because this is the minimum cash. Okay, you can see the minimum cash was 186 and this is your ending cash also, because whatever cash we have above this 186, that is being used to repay the debt. So let's suppose the company has this much cash, 3141. This is the cash the company has generated. This cash has been used to pay the debt. Okay, company generated 3328. We kept 186 in the balance sheet. Remaining cash we used to pay the debt. 1937 was paid to pay long-term debt, and 1204 was used to pay the revolver debt, right? So what we want ending cash. So now you just add these two values, this plus this. Okay, now revolver, this amount we have to use to pay the debt now, equal to minus how much is my outstanding revolver. This is my outstanding revolver, this is the term loan, and this is the mezzanine debt. We need to pay all these three. So I'm taking the first one first, and then second one. I can bring the third one also here, but we have created one additional line here, that how much cash we have available to pay mezzanine debt. However, this was not even required, but we still have that. So this plus this plus this. Now we need mezzanine finance, mezzanine debt. This is the debt, right? We shall pay this also. Let me put it with a negative sign. Equal to this plus this. 68365 is the amount that we have. Now if you have preference dividend, we would want to pay that also. So equal to minus, come above and look for sources of finance, and here we have this preference stock. Why we are not getting preference stock? Because we are not using that. If you want to use this, you need to make, yes, preference equity, yes. If you put it 1, if you put 1 here, automatically the funding will come, but in our case we are not using it. So this plus this. After that we need management pay down. Again for this equal to minus, come above. Here we have an option which says that we have to pay 10% to management if we have this condition before acquisition, right? This condition may be available or may not be available. Like in this case, we have not activated this assumption. We have not set this condition that we will be paying 10% to the management when we will sell this company. But this condition may be there in some situations, right? But in our model we have not taken it, but I will just show it. This into this into just a second, this particular cell. Okay, now I'm not getting any value here. Let me go back here and make this 1. If I make it 1, then it will become yes. Once I make it yes, you will see that there are some payments which we are making in the model, and you can see the payment is being made here, right? But I don't want to make any payment. It will reduce my IRR significantly. So let me come above and let me change this. Okay, make it 0. Now here equal to this minus not minus, plus this, because this value we have entered with a negative sign, so we have to plus it so that it is actually deducted. Now final step. So this amount you are going to get if you sell this company after 5 years. But what was the amount you invested? Equal to, come here and look for sponsor equity. This is the amount which you had invested in 0 year. Now how much amount you are finally getting? This much. Okay, and now what we need? Cash on cash. How much we are getting in total after 5 years? So this divided by this. So we are going to get cash 5 times the amount we are investing today. Okay, what will be the rate of return? What will be internal rate of return? What will be my IRR? For that we can use a function called rate. Now N per, I can simply type 5 because 5 years later on I am going to sell it, but we can put a formula also like this minus this, comma, PMT would be 0, comma, present value will be this, the investment amount, future value will be this amount. Now how much amount we are going to get, how much IRR we are going to get after 5 years, how much amount we are going to get if we acquire this company with the assumption amount we have taken above, that will be 38%. And if the minimum condition for IRR is, let's suppose, 25, so we are getting much more than that. If minimum expected internal rate of return is 25, then IRR actually in this project is 38%. So we would like to go with the project. Okay, we would like to proceed with this transaction. Now what we want to do a scenario analysis. Like if we sell this company after 5 years, the IRR will be 38%. But if we sell it in 2026 after 4 years, then what will be IRR? If we sell after 3 years, if we sell after 2 years, if we sell just after 1 year, then what will be our IRR? It will be a kind of scenario analysis, right? So what we need to do, we need to simply select this and paste it here. Just we need to be careful of one thing, if we have put dollars properly or not. So dollar is here. In this case it is EBITDA, it will not be locked. I'm just checking whether there is something which we need to lock, and I have not locked it. I'm just checking that. I think everything is right. Okay, what we can do, simply copy this and come here and paste the formula. Now let me check. You can see here that if you sell after 1 year, then the IRR will be 38%. If you sell after 2 years, the IRR will be 46%, then 47%, then 42%, and then after 5 years it will be 38%. So I'm ending this video here only, and you just need to prepare this entire model right from scratch like this. Open the blank Excel file and make the model again the way we have created this model. Okay, thank you so much. If you have any query, you can connect with me and we will try to solve that problem. Thank you so much.